My name is Andrew Quinn. In the box to my left is John Stauffer, my partner, and we are financial advisors here in Nashville. We've been giving this presentation to MBA seniors for close to a decade, and we focused on just personal finance in the past, which can be pretty broad. Today, we're going to touch specifically on investing and walk you through some of the basics. Show you some slides and information that to teach you a little bit about this and hopefully pique your interest so that you start a lot earlier than we did, and give you some of what we've learned over the years, both as individuals and investors.
Yeah, guys, we're excited to be with you today. This is something Andrew and I look forward to doing every single year and have been doing it for some time. And yeah, we just hope that you can take away a few things that we wish we'd known when we were your age, as well as some beneficial things that we've learned over the years in managing clients' monies. And we are in social distancing right now with the coronavirus going on. So this is kind of an interesting way to give you this presentation, but we know y'all are doing a lot of remote classes as well, and we were glad to put this together for you. So guys, as we mentioned, we typically come and talk more about personal finance, which includes things like budgeting and cash flow, savings and investment, debt, equity, retirement, insurance, tax, legal. Those are all areas that we help our clients with in our practice. But MBA has asked, in light of what's going on with the economy and the stock markets, that we try to focus more today on savings and investing. A lot of the how do you succeed across all of personal finance really plays a big role in the savings and investment component as well. So you're going to hear us talk about things like behavior, habits, knowledge, planning. We are certified financial planners and do believe that all this kind of goes together, but today we're really going to focus on the investment aspect.
So a big part of investing and what you guys have on your sides is time. The earlier that you start, the more that you can take advantage of time. And what we've written down here is compound growth, which means not only saving, but having your savings earn more for you. So for instance, if you save $100 and make 5% on that in 1 year, the following year you'd have $105. And if you made another 5%, it's compounded on that 105. So if you then take that out over many, many years, it can become very powerful, which we will show you later on.
Some public investment options are things like stocks, bonds, currencies. You can buy and sell those with various apps or platforms out there. There's a private investment world. If you invest into real estate or private equity or venture capital, we're going to spend more of our time today talking about the public aspect of it, though.
And not only time being one of the biggest factors, we also believe behavior can be something that really will dictate how successful or unsuccessful you are, because there are things you can control and there are things you cannot control when it comes to investing. Behavior is something you can control, but it's more difficult than it may seem to be a good behaviorally smart investor.
And then, of course, focusing on risk and return, investments have a trade-off on that. So, Andrew, you want to talk about that a little bit?
So, again, John said we're going to focus on publicly traded, meaning you could open up an account and buy any of these things. The lowest risk, and risk and return essentially work hand in hand. The lower the risk, the lower the expected return you can have. And the higher the risk, the higher the expected return. But, of course, the more potential for you to lose money as well as gain money. So cash and CDs are bank instruments to where they're essentially guaranteed. You know you're not going to lose, but at the same time, you're not going to earn very much. Money market and banks are paying 1 to 2% on your cash and CDs, which is well below what you could earn in, some of these other options like bonds, like stocks. And we're going to be really focusing on the stock market today because we think that's where young investors especially have the most upside, and it may make sense to take risk when it comes to owning stocks. There are many, many ways to invest. ETFs and mutual funds are kind of a basket of some of these stocks, bond options. But again, we're going to focus on that stock portion today.
This chart shows the stock market going back to 1900, and it's also put in what's called a log scale. So it really just shows how long it takes to double, or in this case, go up tenfold over the same increments. And this is really just showing some major areas of the stock market, like the Roaring '20s, the Great Depression, after the various wars, and even up into the technology boom in the late '90s. This chart is showing, I think, through 2019, kind of beginning of 2020 over here. But the big takeaway from here is over time, the markets are going to go up. And we're going to talk a little bit more about fear that occurs along the way and things that cause people to think that, oh gosh, this time is different. The stock market is just going to tank and never recover. But the different periods that you're seeing highlighted here are showing recessions that have occurred in the past. But the good times in the market where things are really going up, like here in the late '90s, that's referred to as a bull market. Whereas you can see since then, there have been a couple dips like the dot-com bubble and the great financial crisis of 2008 that's referred to as a bear market. One thing I always found interesting is, why is it referred to as a bear versus a bull market? And it's how a bull or a bear attacks. If you think about it, a bull starts with its head down and its horns down and then lifts its head up in order to attack, whereas a bear will start standing up on its hind legs and its paws up and then come down on its prey or whatever it's attacked. Similarly, a bull market is meaning a market that's going up, whereas a bear market is a market that is going down and characterized by falling prices. Technically, a bear market is defined as a 20% decline from a recent high. And so when they talk about, how long a bull or bear market lasts, it really just comes down to what they're measuring the bear market. And then once it recovers and starts gaining again, it re-enters a bull market.
Here's another slide showing you in a different way some of those bullish and bearish periods. The red being where we were in a bear market, and those usually coincide with recessions, which you see in the gray bars. Recessions, of course, meaning unemployment's higher, corporate earnings are lower, economies of the world are not quite clipping along, and that there's various factors that cause these recessions, but that's usually where you're going to see bear markets. Another way to look at this slide is there's a lot more bull markets than bear markets, but that doesn't mean the bear markets aren't painful. You'll see in the Great Depression back in the late 1920s, early 1930s, the stock market went down 83%. That is hard to stay invested during that. And we've seen a recent sell-off that also, there's a lot of fear and uncertainty. And so investing through those periods can be difficult, but we're going to talk about a couple things that can help you through that. Last thing I want to point out on this one is this chart is a little dated. This is probably 5 or 6 years ago. And so we were about 5 years into this most recent bull market, which technically ended in February of this year, 2020. At that point, we were 11 years into a bull market, which was technically the longest bull market ever. Another way to think about that is the good periods aren't going to last forever, but also the bad periods aren't going to last forever. And so trying to have some historical perspective can help you regardless of the current market environment.
So this is another way of looking at the returns and the corrections that occur within the stock market. I think it's important for investors to know that if you're going to be in the stock market, you need to expect that there's going to be a lot of volatility, just a lot of times where the market's going up and a lot of times where the market is going down. So this is a chart put out by JP Morgan. They do it quarterly, and we've actually grabbed the most recent quarter in through March 31st of 2020. But what this is showing, the gray bars that you see on the top here, these are the calendar year returns for the stock market. So in 1980, from January 1 until December 31, the stock market made 26%. If you had just put your money in on January 1 and hadn't looked at your account until December 31, you're saying, man, I had a great year, made 26% on my money. However, the red dots are the corrections that occur along the way throughout the market. Maybe the market started at 0 and went down 17% and then came roaring back, being up 26%. or maybe it started at 0 and went up above 26%. And by the end of the year, it was back down to just being up 26%. The red dot is just measuring the biggest loss. So from the highest point the market was at some point in the year to the lowest point, how much did you see your investment go down? So if an investor was looking at their account every single day throughout the year, even though it was a great year overall, 26% return, they might find it troubling at some point and say, man, I've lost 17% of my money from the highest that it was. So this chart really helps put into perspective over a long period of time, in this case, over 40 years. Well, 30 years had positive return, and you can see just some very strong returns, as high as 34% in this year. But the average decline that occurs every year is 13.8%. So every single year, you can expect your investments to give up almost 14% at some point, and that's indicated by the red dots along the way here. Some years more painful than others, like in 2008, that calendar year saw a 49% decline. And where we are so far through the end of March this year, the market was down 20%, but at some point from the high to the low, it lost 34%.
Yeah, and John, also to your point, the longer you look, the less the volatility tends to smooth out. So on any given day, the stock market is essentially a coin flip on whether it's going to be up or down. Call it a 50-50 chance. We've extended the period here, and you see the market's up on average 3 out of every 4 years. So if you look at 5, 10, or 20-year periods, if you look at any 20-year period, the market's never been negative. The longer you can give yourself for your money to stay invested and grow, the better odds you have. It's good to know going in, if you see a big drop, that doesn't necessarily mean that's abnormal. It's actually normal for stocks to fall, because that's the price you pay to achieve some of these calendar year gains that we're showing.
We just entered a bear market. February 19th was the high of the market in 2020. And as we showed on that last chart, there was a 34% decline from that point. But bear markets, they're tough on people that might have stopped working or retired or living off their investment. But we actually think that for younger investors, bear markets have a major benefit. What this chart is showing is if someone had started back at the end of the tech boom in 1999, 2000, I think the high was around April the 11th. If you had put all your money in the investment markets that year and just left it until the end of 2019, you would have earned 6% on average on your investment. Now, that includes riding through 2 major bear markets like 2008 and the dot-com bubble. However, if you had started investing after the first bear market shown there, so somewhere around August of 2002, and then you invested until the end of 2019, you averaged 10% on your money. If you started at the top before the 2008 bear market, well, your average rate of return through 2019 was 8.71%. And if you had started at the low, which was March 9th of 2009, you had almost a 20% average return from that time through 2019. So the point is, bear markets are painful, but after a bear market, the future returns tend to provide higher gains for investors. So it's a great time to be thinking about starting to invest.
So here's another way of showing what John was just talking about. These are the historic bear markets, meaning a 20% or greater fall from the high. And this is going back all the way to the Great Depression. So you'll see some of these bear markets can be extremely painful in terms of losing 50% if you'd stayed invested. The Great Depression is, of course, the worst. But what we want to remember is that when prices fall, your expected future returns go up. What that means is the lower values go, the greater return you have, the potential for greater return you have coming out of that. So the peak is where the market hit the high. The trough is where the market hit its low. And the 1, 3, and 5 year returns that we're showing you is what the stock market did after it reached that low, after it reached the trough. Here's some of the historical returns that we've seen, but you'll see the averages below. Those are pretty attractive forward-looking returns. Not to say you're not guaranteed any of those returns. You'll see different periods gave you different percentages, but you just have that potential if you can begin investing, remain invested, continue investing to have some pretty attractive forward returns. At the bottom there, we showed you a snapshot of the middle of this most recent sell-off in March. The market was down 30% almost. It got as low as 34%. We don't know what it's going to look like in 1, 3, 5 year returns. But again, this is why it's important to keep that perspective and learn from history as to what the potential may be coming out of what we're in right now, which was a recent bear market. So switching gears, now we want to talk about how saving and investing play together. So of course, $1 million is a lot of money, and it's a goal many investors have. But in terms of getting to that $1 million mark, time is on your side again. So in this scenario, we've said you have someone making $50,000 a year, and we assume that they get some, bonuses and raises, or rather, really just cost of living increases throughout their career. So it's not just $50,000 every year. But what we want to show you also is they start contributing 4% of their salary from the get-go, that being $2,000. They also get a company match, which is what most companies offer as part of a 401k retirement savings plan. So that 4% is matched 4%. So the total contribution is actually $4,000, not $2,000. And that match is free money. Essentially, it's 100% return on your dollar. So you want to always make sure to take advantage of any free money that a company will pay into your savings. And then what we show you here is the longer that you can continue to do this, 10, 20, 30, 40 years, the more that compounding works. And you'll see towards the end, compound growth in terms of dollars is a whole lot more than that at the beginning. You go from 4,000 to 60 to 200 to 500. And then after 40 years of doing this, you're over $1 million. Now, it doesn't go straight up 8% a year in real life, but this illustration shows you that starting early and taking advantage of your savings rate, a match, and time is really how you get to some of these goals.
So the next slide, we have another example of, it's kind of two different columns here. And it really is meant to illustrate the importance of starting your savings early again. On the left here, we've got a person that started saving $6,000 per year. And we're assuming a 10% annualized return, which is possible. It might be on the aggressive side, but we're trying to illustrate the point here. So the person on the left, $6,000. So after the first year, they just set aside $6,000, and we're assuming there was no growth that year, just to be conservative. The next year, they put aside another $6,000, and the original $6,000 grew 10%. So at the end of year 2, they're at $12,600. This person started earlier and did that for 8 years. They would be at $68,000. And then the second person, they didn't save anything for the first 8 years. And then they started saving $6,000 a year with the same rate of return going forward. Well, after 45 years, the person on the left only set aside $48,000, and they were left with an ending value of $2.3 million. Whereas the person on the right, because they waited the first 8 years and then they saved $6,000 a year for the rest of their working years, they actually set aside more money and had a lower balance. That is the power of compounded return and why you really want to try to start saving earlier.
We want to switch gears and talk about behavior. And we said earlier, time and behavior are two things you can control, which can have the biggest impact on your success or failure as an investor. We've got a couple quotes up here that we think are very helpful in terms of describing how behavior can affect your investing. I think to understand the human side of it will help you avoid some of the pitfalls, because we are not programmed to be good investors. Losses have proven to hurt twice as much as any gains in the market. And that's why people love it when stocks go up. But when stocks start going down, many are tempted to bail out. That is loss aversion. That's a behavioral bias that we have. The other, there's many of these, but recency bias would be, hey, this one stock or this stock market or whatever it is, this cryptocurrency, Tesla, whatever it is that you're looking at, it's really done incredible of late. I want to pour all my money into that. In that instance, you're chasing performance, which can also burn you. And the last being, and it kind of plays into that, let's say you did pick a great investment and it so happened to have a huge return over a certain amount of time, and you felt like you were the best investor in the world. That can also come back to bite you. The market can be very humbling, and I think understanding some of these biases can help you kind of remain consistent through it. Warren Buffett is considered the greatest investor of our time. His most famous quote is the one you'll see here about being greedy when others are fearful and fearful when others are greedy. Another way of saying you want to buy low and sell high, which can be a lot harder than it sounds, because only in hindsight, when we look back, do we know when the lows and the highs are. What Warren Buffett is talking about there is controlling your behavior. It's hard to do in the moment when everyone is saying sell, when you turn on any financial news network and they're calling for doom and gloom. It can be tough to stick to it. What we try to coach is focus on those things that you can control. Focus on your savings rate. Shoot to save a higher percentage of your income as you continue to develop in your careers. We keep hitting on this, but start early. And you remember, you could start right now. You can open up an account and start investing right now. Nothing is holding you back there. During periods of difficulty in the market, that can be the best time to buy into stocks. And as counterintuitive as it sounds for younger clients, we tell them those bear markets, that's where if you can just keep putting money into your account, that's where your dollars are really going to earn the most, because you're going to continue to buy at lower values. The last one is, and we're going to jump into this now, dollar cost averaging. It's a way to control or really take yourself out of the picture by sticking to an automatic savings plan. It takes you out of the guessing game. So John, I'll let you touch more on dollar cost.
So this chart really shows dollar cost averaging well. What this is showing is the ending balance of a $100 contribution. If you put in $100 every single month going back to before 2010, what each dollar amount grew to. And so what you're seeing here is we've put the market down here below. This is the S&P 500, and it's showing that this was the 2008 crash in the market. And if you had been putting in $100 every month during that time, that $100, like at the very peak, one of those $100 contributions grew to over $400 by the end of 2019. And so when the market is going down, that is actually the most opportune time to put money to work, because as the market kept going up over here, well, every $100 monthly contribution then didn't grow as much, because one, the market was more expensive, and then two, you didn't have as much time to let it grow. So it can be very scary. We hear people all the time during a bear market say, I don't want to put any more money into the market because it feels like everything that I'm putting in just disappears. But in reality, those are really the most beneficial times to be putting dollars to work.
And here's another way of looking at that. There's always a reason to sell when it comes to the market, especially during bearish markets. That's what you're going to read. That's what you're going to see. That's what CNBC will be blasting out, and Bloomberg and all your alerts is the market's dropping. Everybody wants to be in cash. Everybody wants to be out of it. The news in general tends to highlight the bad things going on. They're rarely going to, say, here are all the good things going on. But over time, the U.S. and the global economy has proven very resilient, and we've always progressed. And the companies, the stocks that you invest in, their goal is to generate profits. And those profits then will generally lift their share price, and that's how you make money over time. So we wanted to show you it's not a straight up. The stock market, the longer you give it, the more gains you have the potential for. But that doesn't mean that you're not going to have periods where it's tough to remain invested, and the market either is falling or it's not really going anywhere. That's where, those recovery periods that we're showing you here in pink, that's what it's showing is that those are tough times to look at your account value, but that also is great times to continue to invest through it. I know this slide's a little hard to see, but basically, as you can see on the right, 1983 through 1994, those were all the bad things that were going on in those years. Those were the panics, those were the wars, those were, you know, the financial and media everywhere highlighting, here are the bad things going on. And still, if you stretch it out, the market continued to increase, meaning your account value would continue to increase. So there's always going to be reasons to sell, but we wanted to point this out because people aren't always going to be talking about reasons to buy through this.
Another thing that's very important when it comes to investing is what we call asset allocation. It's actually a slide from Vanguard, and it's showing different allocations. If an investor were 100% in bonds, or if they went 10% in the stock market, 90% in bonds, all the way down to being 100% in stocks. And so this is showing from 1926 to 2017, bonds averaged 5.35%. But if you take into account what inflation did, so the cost of gas, the cost of milk, all that got more expensive, your purchasing power really only went up by 2.39%. Whereas the more aggressive you got with stocks, yeah, your average return just mathematically was 10%, over 10%, and then after inflation was over 7%. So stocks tend to give you more return over a longer period of time. Now, the more stocks you own, the more risk you're taking. And we're kind of seeing that with these different columns over here. So just first off, seeing like the number of years with a loss. You were 100% bonds over this 92-year period. You only saw 14 years where you actually lost money. Whereas being 100% stocks, you lost money in 25 out of those 92 years. And then this is kind of highlighting some of just the cumulative returns during a bad market. So 1973 to 1974, bonds were down under 5%, whereas stocks lost you 37%. But remember, even with those negatives, over time, you had higher average rate of returns. And then you can see some of the good years, like 2002 to 2007, bonds made 26%, but the stock market made over 100%.
So here's another way of showing you diversification. John was just going through, different stock bond allocations, and we're keeping it pretty simplistic in terms of your investment options. We're not diving into all the different types of stocks and bonds or other options, but bonds generally can act as kind of a more conservative hedge against stock market risk. That doesn't always mean that they're going to go up when stocks go down, but they're certainly not going to, they don't have the same amount of risk that stocks do. So what we're showing you here, the orange line here is the U.S. bonds. It's the Barclays U.S. Bond Aggregate Index going back to early 2000s, as compared to, in light blue, U.S. stocks. The S&P 500 tracks the 500 largest U.S. companies that are reflective of different industries. So you look at that and you say, well, why wouldn't I have wanted to be in all stocks? You know, that dip in 08, it doesn't look so bad when you extend over a longer period of time, but you'll see bonds held up when stocks really sold off. The third line in purple is kind of a 60-40 allocation of light blue stocks and orange bonds. So you'll see didn't fall as much during the last bad period and this most recent one, but didn't quite get you the gains that being in all stocks would. Now, you can cherry pick time periods, and the next slide is going to show you, okay, that was a long period with a couple bear markets, but good return for stocks where bonds lagged. Here is, we're in the middle of what's happening right now, and this goes through, probably towards the end of March. From when the market peaked, most recently, which was February 19th, that was the all-time high. From there, stocks sold off really faster than they ever had. There was a 34% sell-off. At this point, it was 30%, that the market just seemed to only go down and in big chunks every day, which is what will happen a lot during bearish periods in the market. The percentage losses can be a lot greater than the percentage gains that you'll see during bullish periods. But you'll see that orange is the benefit of diversifying. That's your bonds, which actually were positive during this period of minus 30 stock return. And then that purple is a 60-40 again. You're getting 60% of that sell-off, but you're also getting the bond portion hedging out some of your risk. One more slide we want to show you about diversification is single stock risk and also single stock returns. Here's a chart, a 5-year chart showing you in purple, that's the S&P 500. Think about that as just the stock market, the US stock market. That's an index that's reflective of it. Orange now is what all of you know very well. There's your iPhones. That is Apple stock over the past 5 years. And you say, that's where I wanted to be, right? I was up 120+% as compared to 40+% for the entire market. Light blue is Macy's. That's a retail store which have really been hurt by, the Amazons and the online shopping of the world. It seems in hindsight, of course you want to be in Apple and out of Macy's. At the time, 5 years ago, you don't know what these stocks are going to do going forward. That's where you're taking additional risk when you pour all your money into one company. Even if it's a company like Apple, you see that drop right there. Apple has had many 50% drops from the high. So you have to ask yourself, what's this company going to do going forward? And am I going to be able to stomach the big sell-offs if I am concentrating in one company?
So the next 2 slides are meant to illustrate just the reality that when you first start off investing, your savings rate is actually more important than the rate of return that you're going to earn. Green bars is kind of illustrating how much a portfolio was saved in, and then the reds are kind of starting to show how much gain or loss contributed to the overall value of the portfolio. So in this first half, you can see, or at least this first third, savings really was everything. Investment returns started to have some impact on the upside or downside of the portfolio. But then once you've accumulated enough, that rate of return really is what's going to drive your investments. Once you've accumulated enough investments to really start compounding and growing, that's going to really dictate what the value of your portfolio is in the long term. So this second chart just illustrates it. This was an actual simulation we did where we said if somebody started off making $75,000 per year in 1995, and if they had put aside 10% of their money and received a certain match on their contribution. Well, again, the first almost 2/3 of this chart, even though there was a good bull market in the late 90s, your portfolio total value, that blue, was mainly comprised of your total contributions. The growth of the market during that time kind of helped. And then with the dot-com bubble, it really took away some of that growth. But then after the dot-com bubble, the market had another good rally, and still your contributions made up the biggest portion of your portfolio. But at some point, this will swap, and especially if you've accumulated enough before a really good bull market were to occur, that's when you really start seeing your investments take off and your account values growing.
So how do you start doing all the things that we've shown you today? These are some options for you. Those 3 links on top, that's where you can basically start playing around with what we're talking about: buy stocks, sell stocks, bonds, etc., and do it with a mock portfolio. So it's just an online free tools where you can kind of get some practice before you start putting real dollars to work on investing in different companies and just watching them, tracking them. That's how you learn. It's never been easier to actually invest your dollars. There's the transaction fees to buy stocks, to buy funds, have essentially come down to zero. Robinhood is a startup that really drove a lot of that race to zero that we've seen across the board. It's a app you can download to your phone, open an account, and put money in and start buying companies, buying funds. The earlier you could start doing this, the stakes are a lot lower. So even if you lose money, it's not going to be the same as if when the stakes are higher later in life, and you've got a lot more time on your hands. So these are things you can start doing right now with summer jobs, with jobs in college, with your first job coming out of college. Make sure that a portion of what you're earning is going into saving and investing for you. This one we just wanted to show you. Often I find that when it comes to investing, start with stuff that interests you. I've put up some companies here that many of you will likely be familiar with: Apple, Tesla, Twitter, Facebook, Amazon. 4 out of 5 of these have had pretty great returns going back to late 2013. These are companies that that you use, the products. You can track them on a day-to-day basis, but also if you're a consumer of them already, it may interest you a lot more to buy into these companies. The majority of your money should be in kind of diversified funds that hold many of these. But as you're starting out, I think it will really help you stay engaged if you buy companies that you use, that you know, that you like. And, you know, everything we've talked about today in terms of being publicly traded, all of those companies up there, you can buy shares in. On any given day, you can become an owner of these. So we think it's a great way to start and to help you stay interested and learn about investing is through companies that you're already familiar with.
We've covered a lot from a high level on investing. We've tried to consolidate it down, just 5 tips here. I think we really try to, you know, ingrain in that starting early and enjoying compound growth is somewhat the biggest key to investing. Take advantage of free money when you start working. If your company offers a match, like a 401k, you want to put whatever dollars you need to get all of that match, because that's a free 100% return. It's the only investment that will ever guarantee you 100% return on your money. Dollar cost averaging just takes the guesswork away. Nobody can call when the market is at its top, or if it's, you know, been going down where the bottom is. And so you just want to keep contributing to your investment accounts. Make sure to educate yourself on risk and return. There's a lot of great material out there that you can read about. And the best education is, like Andrew was showing with some of those apps, just go either do a mock portfolio and try it, or eventually start putting some of your own money to work. That's where you really will start paying attention on it. And then again, just early on, savings is more important than rate of return. So just stay motivated and focused on how much money that you can set aside going forward.
We've also included from our old presentation just some tips, blunders that John and I made, things that we wish we had known going into college. We'll leave that for y'all. You know, you're going to have a great time over the next 4 years. Make sure that you are making yourself marketable through working hard, but also gaining some good experience for the resume, just like you've done to get into these colleges where you're headed. Make sure you're taking advantage of the time you have there. We appreciate the opportunity, as always, to talk to you guys. If you have any questions, we are available. Again, we have a financial planning firm in here in Nashville, so happy to talk through any of these slides with you, or any other questions that you may have. Feel free to reach out. And have a great rest of the school year. I know it's a weird one. Have a great college experience.